don't know where to begin, better ask Win.
Winston, it's good to see you. I was really surprised to learn about this recently. It's called the 401k rollover mistake that's costing retirement savers billions. So there are so many benefits to rolling your 401k into an IRA, but it turns out workers are missing out on billions in investment gains by pulling their retirement savings out of the stock market after switching jobs. So tell us about what's often happening when people roll their 401k into an IRA.
Well, there's this little line I hear repeated over and over from people that I'm moving my money to cash. And somehow they feel that that's a very safe way to avoid the volatility in the stock market. But it's almost a surefire way to just have your money start going against you, because money is never really sitting still. I learned this a long time ago from one of my mentors in the business. Money is either growing or going. But if it's sitting in cash, it's missing out on its growth potential, and it becomes subject to the razor's edge of inflation and the loss of compounding interest potential.
Right. And so just to put a finer point on this study from Vanguard found that 1/3 of people who roll their 401k into an IRA are still sitting in cash 7 years later. So just say that again, Winston. Why is sitting in cash so detrimental when it comes to saving for retirement?
Well, a thought comes to my mind. It's the old saying, the paralysis of analysis, okay? When the money goes into cash, we inevitably have this ability to innately put off making a decision of which investments to put the money into, because people that are working, the DIY, do-it-yourselfer crowd, they're trying to analyze, they're trying to study, they're trying to research, they're trying to educate themselves. And the paralysis of analysis steps in and nothing happens at all. And the next thing you know, according to that Vanguard survey, 7 years has gone by. They left the money in cash. They missed the last bull run on the market. And then they hear things are starting to go good in the market, so they buy in when the markets are high.
Mm-hmm.
What
Right.
could go wrong?
So according to this study, for investors under age 55, researchers estimate that the long-term benefit of investing in even a target date fund instead of just sitting in cash was a difference of $130,000 when it came time to retire.
Yeah, that's true. The target date funds are funds that basically depend on two variables, your age and that date when you're ready to retire, right? Because a target date fund is designed to get narrower in focus. In other words, less risky the closer you get to your quote end date, your retirement date. But even a target date fund will outperform cash over that period of time. And we'd recommend it over cash.
Mm-hmm. But if somebody would like to talk to you to find a unique way to invest in an IRA that requires so many more variables than just your age and when you want to retire, how can they reach you?
Well, they can reach us by calling us at 602-456-1928, or they can reach us online at winstonandcompanies.com. We could help you design a plan that's appropriate for your retirement experience, a little bit more detailed, a little bit more personalized than a target date fund, but certainly going to be a lot better than that cash position.
Certainly. Yeah. Glad we got to talk this one through. Winston, thanks for your time.
Great seeing you again, Erin. Bye-bye.
Got a plan for your retirement, 'cause it's just down the road. But if you don't know where to begin, better ask Win.